Right, let's talk about crypto ETFs. ETF sounds like a noise you'd make after a particularly unsatisfying meal, but it's actually important. An ETF, or exchange-traded fund, is basically a basket of stuff you can buy and sell on the stock market. Think of it like a pre-packed lunchbox of investments. You could buy a little bit of Apple, a smidge of Google, a sliver of that novelty socks company, all in one go. It's diversification for people who can't be bothered to, actually diversify. It's the financial equivalent of buying a greatest hits album instead of every single record by the Bee Gees. So, what happens when you take that concept and jam it full of cryptocurrency? You get a crypto ETF. It's a turducken of modern finance, a stock stuffed with a fund stuffed with Bitcoin. Instead of going through the absolute rigmarole of setting up a digital wallet, remembering a password that looks like a cat walked across your keyboard, and praying you don't accidentally send your life savings to a North Korean hacking syndicate, you can just buy the ETF. It's crypto with the safety wheels on. You get to bet on the price of Bitcoin going up or down without ever having to touch the actual, baffling digital coin itself. It's like betting on a horse race without having to go near a horse, which, let's be honest, is a massive plus. Now, why does anyone care? For years, crypto has been the Wild West of finance. It was exciting, it's volatile, and it's full of people on the internet using rocket emojis. Big-time investors, pension funds, mahogany desks have mostly stayed away. It was all a bit too grubby for them, but a crypto ETF listed on a proper exchange changes the game. What could possibly go wrong? Enter the regulators. Specifically in the United States, we're talking about the Securities and Exchange Commission, or the SEC. Now, the SEC's job is essentially to be the adult in the room of American finance. They're the ones who are supposed to make sure that the financial markets aren't a complete and utter casino, to protect investors, maintain fair and orderly markets, and facilitate capital formation. Think of them as the lifeguards at a very, very large and confusing swimming pool filled with sharks wearing tiny business suits. For the longest time, the SEC looked at the idea of a Bitcoin ETF and basically said, "Absolutely not, are you insane?" Their reasoning wasn't entirely crazy. The crypto market is famously susceptible to manipulation, fraud, and the kind of wild price swings that would make a seasoned roller coaster operator throw up. The SEC feared approving an ETF tied to a spot price they couldn't guarantee was safe from chicanery. Without their blessing, a crypto ETF can't be listed on a major United States exchange. Their decisions are the gatekeepers between a weird niche asset and a multi-trillion-dollar pool of institutional capital. It was a parade of financial firms lining up to ask, "Can we play with the volatile magic internet money, please?" And the SEC consistently responding with a firm, "No." There was massive tension. The industry wanted legitimacy and massive cash. Regulators wanted to protect retirees. They must balance innovation and investor protection, like trying to teach a tiger to be a house cat. Their approval, or lack thereof, shapes what you are and are not allowed to invest in. It might be possible, but expect to lose a limb or two in the process. So what changed? After years of saying no, the dam finally broke. In early 2024, the SEC finally approved the first ever spot Bitcoin ETFs in the United States, in a decision that was about as enthusiastic as a teenager doing chores. Fine, you can have it, but we still think it's a terrible idea, and you're all going to regret this. It was the regulatory equivalent of your dad giving you the keys to the car while simultaneously handing you a pamphlet for the local bus service. The approval was a massive game-changing event for the entire industry. Let's break down what this new rule actually means, step by step. First, the approval was for spot ETFs. This is crucial. Before this, we had futures ETFs, which bet on the future price of Bitcoin. That's like betting on what the weather will be next Tuesday. A spot ETF, however, is backed by actual real Bitcoin. Diagram. The company offering the ETF takes your money, buys real Bitcoin, stores it in a vault, and gives you a share of the fund. Big firms like BlackRock and Fidelity have to buy and hold Bitcoin in secure vaults. That ties the ETF price directly to the spot price of Bitcoin. Not a bet on the future, but a share of the present. The SEC demanded immense transparency. Disclose exactly how much Bitcoin is held, where it's kept, and how it's protected. They also forced giant warning labels in marketing. Sure, you can buy this, but don't come crying to us when its value plummets because of a rumor started on a subreddit. The impact of these new rules has been, to put it mildly, enormous. For investors, the change is honestly revolutionary. Suddenly, anyone with a standard retirement or brokerage account can get exposure to Bitcoin with the same ease as buying a share of Ford. Imagine your grandmother being able to add a slice of Bitcoin to her portfolio through her trusted financial advisor. The launch of these ETFs saw billions of dollars pour into Bitcoin in a matter of weeks. ETF providers must buy real Bitcoin to back their funds, creating massive, consistent buying pressure. It's kind of like a giant, automated machine that just keeps buying Bitcoin, day in and day out. This has helped push the price of Bitcoin to new highs. ETFs have become a huge source of demand, altering supply and demand dynamics. It's no longer just individuals. The biggest names in finance are involved. Firms like BlackRock now hold tens of billions of dollars worth of Bitcoin. When massive asset managers get involved, it sends a powerful signal. This asset is now part of the established financial system. It provides institutional validation crypto enthusiasts have dreamed of. Of course, it also introduces new risks. Bitcoin can become more correlated with the stock market. If stocks plunge, investors may sell Bitcoin ETFs just like other stocks, causing price crashes. Crypto is no longer in its own little sandbox. It's now playing in the big leagues, tied to earnings, interest rates, and the general mood of Wall Street. Depending on your view, that's either a triumph or a tragedy. So, with Bitcoin ETFs now a reality, what happens next? Well, the most obvious next step is expansion to other cryptocurrencies. Just months after Bitcoin, the SEC approved ETFs for Ether, the second largest cryptocurrency, suggesting the regulatory doors are slowly creaking open. The industry is buzzing with speculation. Solana ETF, Dogecoin ETF, a basket of meme coins. Each approval will let more complex products be built. Think options, other derivatives, allowing sophisticated bets. Or, let's be honest, more degenerate gambles. It will likely drive increased institutional adoption. Pension funds, endowments, and sovereign wealth funds may allocate a small slice to crypto ETFs. Even tiny allocations from these giants could mean hundreds of billions of new dollars flooding the market. We are still in the very early innings of this integration. This is just the beginning. However, the regulatory story is far from over. The SEC approved these products, but they still don't love them. Expect continued scrutiny around custody, trading, and more rules. Global regulators are cautious. Political wins or a new SEC chair could take a harder line, possibly halting or reversing trends. Ultimately, the arrival of crypto ETFs is a watershed moment. Crypto officially crashed the party of mainstream finance. Whether this leads to maturity or a new way for people to lose money remains to be seen. Keep watching. This alters the future of money.